Hey, what's up everyone? It's Financial Freedom. We're back with another video, and today we're diving into a question that keeps a lot of new investors up at night. When you have a big chunk of cash ready to invest, should you invest it all at once or spread it out over time? This is a question I get asked all the time, and for good reason. It can be the difference of tens of thousands of dollars, or even hundreds of thousands of dollars over your investing lifetime. Now there are two main strategies people use: lump sum investing, where you take all your money and invest it right away, and dollar cost averaging, where you invest gradually over a period of time. Both have their pros and cons, and today we're going to break it all down, analyze the data, and help you make the smartest decision for your financial future. Because, let's be real, nobody wants to leave money on the table. We work hard for our money, and we want to make sure it's working just as hard for us. So whether you're about to invest your first $1,000, or you've got a big pile of cash burning a hole in your pocket, stick around, hit that subscribe button if you haven't already, and let's make those dollars work. Alright, let's get right into it. When it comes to lump sum investing versus dollar cost averaging, we're not going off of anecdotal evidence or gut feelings. We're going straight to the data because numbers don't lie. And you know what? The numbers paint a pretty clear picture. Historically, lump sum investing comes out on top. We're talking about decades of data from some of the most respected financial institutions out there. Vanguard, one of the biggest names in the investing world, analyzed market data from 1926 all the way to 2011. Think about that. Almost a century's worth of market ups and downs. And you know what they found? Lump sum investing beat dollar cost averaging a whopping 66% of the time when looking at 10-year periods. But hey, maybe you're thinking, that's just one study, show me more. Okay, no problem. Schwab, another titan in finance, conducted their own research spanning from 1972 to 2022. And guess what? Lump sum investing won again, this time a massive 80% of the time. So, two independent studies, decades of data, and a clear pattern emerging. Lump sum investing tends to outperform. But why is that? Well, it all boils down to one key factor: the general upward trend of the stock market. Over the long term, the stock market tends to go up. I know it might not feel like it sometimes with all the daily fluctuations and scary headlines, but history has shown time and time again that the market always recovers and reaches new highs. And that's where dollar cost averaging can actually hurt you. When you DCA, you're essentially delaying your entry into the market. You might be thinking you're being cautious, waiting for a dip to buy in, but in reality, you're missing out on potential gains. Because while you're waiting on the sidelines, the market could be climbing higher and higher. And when it comes to investing, time in the market is key. The S&P 500, a benchmark for the US stock market, has historically returned an average of 10% per year. Now, I'm not saying you're guaranteed to get 10% every year, that's just an average. But the point is, by delaying your investment, you're potentially missing out on those sweet, sweet returns. So, the next time you're thinking about waiting for the perfect moment to invest, remember that the best time to invest was yesterday, and the second best time is now. Don't let the fear of short-term fluctuations keep you from achieving long-term gains. The data is clear, and the numbers don't lie. Now, I know what some of you might be thinking, but what about that 4% CD? That sounds pretty good. It's risk-free. And you're right. A 4% annual return on a CD is nothing to sneeze at, especially in today's economic climate. It's safe, it's predictable, and hey, a guaranteed 4% return sounds pretty tempting when the stock market can be so volatile, right? But here's the thing, and this is crucial. You have to compare that 4% CD return to the potential returns you could be getting in the stock market. Remember that 10% average annual return of the S&P 500 we talked about earlier? That's more than double the return of a 4% CD. So while you might feel all warm and fuzzy inside knowing your money is safe and sound in a CD, you're also potentially leaving a lot of money on the table. I mean, think about it. Would you rather earn 4% on your money or double that with a 10% return? It's a no-brainer, right? Let me give you an example to really drive this point home. Let's say you have $100,000 ready to invest. If you invest that $100,000 in the stock market and get an average annual return of 10% in 10 years, that $100,000 would grow to a whopping $259,000. That's the power of compound interest, my friends. But if you decide to play it safe and keep your money in a 4% CD for a few years before investing in the stock market, you're missing out on that initial growth spurt. Even if you factor in the interest you're earning from the CD, you'll likely end up with significantly less money in the long run. We're talking potentially tens of thousands of dollars less. Look, I get it. Investing can be scary, especially when you see the stock market going up and down like a roller coaster. But you know what's even scarier? Missing out on the opportunity to grow your wealth and achieve your financial goals because you were too afraid to take a calculated risk. Diversification can help mitigate some of that fear. By spreading your investments across different asset classes, you can reduce risk while still aiming for higher returns. Consulting with a financial advisor can also provide you with a tailored strategy that aligns with your risk tolerance and financial goals, so don't let fear hold you back. Take informed, calculated risks and watch your wealth grow over time. Okay, but what if the market crashes right after I invest all my money? This is a question that keeps many potential investors up at night. I hear you. This is probably the #1 fear people have when it comes to lump sum investing. The thought of losing a significant portion of your investment can be paralyzing. You pour all your hard-earned money into the market, and then, the market takes a nosedive, and you're left feeling like you just flushed your money down the drain. It's a nightmare scenario. But let's take a step back and look at the bigger picture. And hey, market crashes happen. They are an unavoidable part of the investment journey. It's a natural part of the economic cycle. Just like the seasons, the market has its ups and downs. But here's the thing, and this is crucial, markets always recover. History has shown us time and again that recovery is inevitable. Always. Even the worst crashes in history, the Great Depression, Black Monday, the 2008 financial crisis, have been followed by huge rebounds. These events, while devastating at the time, eventually led to periods of significant growth. And that's why investing early is so important. The earlier you start, the more time you have to recover from any downturns. When you invest for the long term, you're not trying to time the market, you're timing the market. This means you're giving your investments the best chance to grow. You're riding out those waves of volatility, knowing that over time the market tends to go up. It's about patience and perseverance. Now, with dollar cost averaging, you might think you're mitigating risk by spreading out your investments. This strategy can help ease the fear of investing a large sum at once. And to some extent, you are. By investing smaller amounts over time, you reduce the impact of market volatility on your portfolio. But here's the catch. You're also mitigating your potential gains. While you're waiting, the market could be moving higher. Remember, while you're waiting for the perfect time to buy in, the market could be recovering and moving higher. You might miss out on significant gains. So, yes, you might snag some shares at a lower price during a dip, which can be beneficial. But you'll also be buying shares at a higher price later on as the market recovers. This can balance out your overall investment cost, and in the end, it often evens out. The key is to stay invested and not let short-term market movements dictate your strategy. You might even end up buying at a higher average price than if you had just invested everything up front. It's a risk you take with dollar cost averaging. Look, I'm not saying that market crashes aren't scary. They are. The fear is real and understandable. But they're also an inevitable part of investing. Accepting this reality can help you stay calm during turbulent times. But the key takeaway here is that time in the market beats timing the market. Consistency and patience are your best allies. The longer you're invested, the more time you have to ride out those market fluctuations and come out ahead. In the end, it's about staying the course and trusting the process. So, where does this all leave us? We've looked at the data, we've analyzed the pros and cons, and we've addressed the fears. So, which strategy comes out on top? Well, based on everything we've discussed, the answer is clear. Lump sum investing is the better strategy for long-term growth. Now, I know some of you might be hesitant. You might be thinking, but I'm just not comfortable putting all my eggs in one basket. And that's okay. Everyone has different risk tolerances, and there's no one-size-fits-all approach to investing. But here's the thing. Unless you're genuinely afraid of short-term volatility, and you think you might panic sell if the market takes a dip, the best move is to invest your money as soon as possible. Don't let fear hold you back from potential gains. So, if you've got that CD maturing soon, and you're wondering what to do with the money, now you know. Don't let that money sit idle in a low-yield account. Put it to work in the market and let the power of compound interest do its magic. Now, this doesn't mean you should never dollar cost average. DCA can still be a valuable strategy for ongoing investments like your monthly contributions to your 401k or Roth IRA, but when it comes to large sums of money, like an inheritance, a work bonus, or a maturing CD, lump sum investing is the way to go. Remember, time in the market beats timing the market. The earlier you invest, the more time your money has to grow. So don't let fear or procrastination hold you back from building the financial future you deserve. So, there you have it. The age-old debate of lump sum investing versus dollar cost averaging, settled. Hopefully, you found this video helpful and you now feel empowered to make informed investment decisions. Remember, investing is a marathon, not a sprint. It's about making smart, strategic decisions that will set you up for long-term success. And the sooner you start, the better. If you enjoyed this video and learned something new, hit that like button And subscribe to the channel for more videos on personal finance, investing, and building wealth. And as always, thanks for watching. Want to maximize your wealth? Hit that like button, subscribe, and let's build financial freedom together.